Debt is something most homeowners face. Credit cards, student loans, medical bills, auto payments. Over time, it all adds up. Tapping into home equity strategically may help you manage debt or cover major expenses. Let's start with the basics. Home equity is the difference between your home's market value and what you owe. You start building it as soon as you start paying off your mortgage, but you can't tap it immediately. Timing depends on the borrowing method, lender rules, and how much equity you've built. You might need to wait from 30 days to 2 years to refinance, depending on the type of mortgage you have, and you may need 20% or more equity, which can be hard for new homeowners. Homeowners typically tap into equity when interest rates are low, making borrowing more affordable, funding major renovations, consolidating high interest debt, or covering large or unexpected expenses. Home equity can be accessed in several ways, with different timelines, rates, and payment structures. Let's explore 5 common options. With a home equity agreement, you receive cash now in exchange for a share of your home's future value. There are no monthly payments, and you don't have to sell your home. You typically need between 25 to 30% equity in your home and a 500 credit score or higher. There are no income requirements with most HEA providers. An HEA makes sense when homeowners don't want to take on additional monthly payments. A cash out refinance replaces your mortgage with a larger loan, and you receive the difference in cash. Because you're taking on a bigger mortgage, your monthly payments may be higher. You'll also need to consider closing costs and any penalties. A refi is a new loan, so you'll need to meet the lender's eligibility requirements in terms of credit score, debt to income ratio, loan to value, and other criteria. You're typically eligible for a cash out refi 6 to 12 months after buying your home. A cash out refinance makes sense when homeowners are seeking lower interest rates or a different repayment period. A home equity line of credit lets you borrow against your home's equity as needed, up to a set limit. HELOCs typically have adjustable interest rates, so the rate can change over time based on market conditions. They come with minimum draw requirements and annual fees, and often have substantial prepayment penalties. Typically, you'll need a credit score above 620, with higher scores qualifying for better rates. Lenders usually require at least 15 to 20% home equity and will also consider your debt to income and loan to value ratios. A HELOC makes sense when homeowners are looking to access their home equity but may not know how much cash they need yet. With home equity loans, homeowners receive a lump sum of cash up front, then pay off what they borrowed through monthly payments. HEL lenders also require good credit, with very good to excellent scores getting the best rates. They also require 15 to 20% in home equity and consider homeowners' debt to income and loan to value ratios. An HEL makes sense when homeowners prefer fixed interest rates and predictable monthly payments. With a reverse mortgage, instead of paying the lender pays you, and the loan balance increases over time. You must use your home as your primary residence, and your heirs will inherit any remaining reverse mortgage debt if it's unpaid at your death. Missed taxes or insurance can lead to foreclosure, and the loan is due when the homeowner sells, moves, or passes. You must be 62 years or older, own your home outright, or have a single primary lien on your home, and can't exceed their maximum loan to value requirement. A reverse mortgage makes sense when homeowners are looking to supplement retirement income and aren't planning to pass down their home as part of an inheritance. We hope you found this video helpful. Check out Unlock and subscribe for more tips on tapping into your home equity.